It's fascinating. People are interested in real estate investing or real estate market in general, but it's such a broad topic. I mean, we could be talking real estate investment trusts. We could obviously be talking residential, commercial, warehouses, shopping malls. It's a huge industry and it's not going anywhere. But you know what? This is a time for expertise. When you get a raging bull market like we had for a few years, come on, it's easy. Everyone's a genius. But now times are far more uncertain, with some areas looking very interesting for investors, but others are dangerous. That's why I'm thrilled to have with me Vision Capital's Jeff Olin. He's the founder there, co-portfolio manager. They've had a terrific track record. Jeff, thanks for finding a time.
Thanks for having me. Nice to see you.
Let's start with this. As I just listed, there's this whole group of areas. There's no such thing as real estate. There's this component, this component, this component, which Vision Capital obviously does a great deal of work in. But give me an idea, just a broad brush of where we are in these various sectors. I mean, which ones are most dangerous? Which ones are most interesting? That kind of thing for you.
Certainly. We are fortunate that our strategy employs a long and short strategy. So to the heart of your question, we're not here to be bulls, as you will, in real estate. And so, today, clearly everybody now understands that office is a fairly challenging place to be. For us, this isn't new. I mean, we saw a 20-year secular decline in demand before the pandemic between 2000 and 2020. I mean, the lawyers don't have law libraries anymore. Deloitte built new buildings in Toronto, Montreal. They went from 300 square feet per employee to 160 square feet per employee. So that was already going on before the pandemic. So office is a challenge sector for sure. Industrial has been a great sector. It's driven by some secular changes. E-commerce is one. Reshoring, return to manufacturing to North America is another. The pandemic showed us that just-in-time supply chain was maybe a dodo bird, and we need to talk about just-in-case inventory management. So industrial is good. We like single-family rental homes when you're challenged because of mortgage rates at 7% to buy a home in the United States. You got to put a roof over your family head somewhere, and that's a sector we like. We hesitant on malls, but we like necessity-based retail, grocery and pharmacy-anchored retail. Irrespective of recessionary times, you still have to eat and you still have to buy drugs. And so there's quite a bifurcation amongst sectors, which frankly is a market that we prefer. I mean, to your introductory comments, when a rising tide is lifting all boats, it's harder for guys like us to differentiate ourselves because we're long, short fund and we don't use leverage. But now, when there's volatility and variability, stock picking matters more.
And I want to emphasize that what's so unique about Vision is that you've done all of your work for all of these years, never had a losing year, by the way, but all of these years you've done it in the stock market, because the stock market can provide, huge discounts at times. You've taken advantage of that, and there's other things it provides, and I'll get to that in a bit about mergers and acquisitions. But just in that point alone, I mean, sometimes the stock market throws the baby out with the bathwater. It's just, and quality things get drawn down. Of course, that's what I'm interested in. That's what people should be interested in. That's what you're looking for. Where are we at in that kind of a cycle? I mean, that the overall market been dominated by, it's certainly recovered, but been dominated by so few stocks. Are there still are you saying they're sort of licking your chops going, there's some values out here?
Yeah, I mean, listen, over the last to meshing the first two questions, if you look at the prior 20 years and you looked at the difference in performance between the best performing REIT quartile and the worst performing REIT quartile, the average differential was 49%. So if there was ever a sector that seemed to warrant a more active approach, real estate would be amongst it. But in the first 6 months of 2022, that differential went to 15%. Everything was getting painted with the same brush. And as we touched on, they're not the same. And so the question, of course, is what was going to change it? And we posited at that juncture two things, one of two or two of two things. The first is earnings. They're not the same. And when you started to see cash flow come in the third quarter last year, and, office stocks, another 1% decline in occupancy, 15% decline in net effective rents, and the single family rental home guy, 15% of renewals, they're not the same. And the second thing is M&A. The difference between real estate and any other asset class is the private market dwarfs the public market, and there's an arbitrage between the two. So today, I mean, you go back to the fourth quarter last year, and you had the REIT index down 28%, whereas private REITs, and it was Blackstone's REIT that got all the headlines, but it wasn't just Blackstone. It was Blackstone, it was Starwood, it was Schroders, it was KKR, names up in Canada. They were reporting up 13% NAV because they were self-reporting based on appraisals that were tough to get done and because transactions weren't happening. Does that make any sense? A 41% gap? It does not make any sense to have a premium for illiquidity. Does that make any sense? It makes no sense. And the question is, which one was right? And we say both. In some sectors, the stock market got it right. Office stocks have been crushed. So we've covered a lot of our shorts in office because it, 75, 80% down in some of these stocks. In other sectors, industrial, the stock market got it wrong.
And let me just reemphasize something because it comes by quickly. The thing that Vision has had, I think, is a tremendous advantage over the years is that you can play the stock market for stocks to go down or to go up. So you've had many big successes. I remember, when the oil fallout was coming in mid, 214, 215, 216, you did very, very well saying, hey, these are the kinds of things that will go down in this market, the kind of real estate that will go down. And, so it's a tough time. But I think just to reemphasize for people, this is a long and a short fund. So let me come back to the REITs that, again, it comes by quickly. My goodness, that's a differentiation between REITs. I mean, that's incredible. Like, in other words, that's maybe the most straightforward way of saying some are good and some just are crap. And then, of course, your job with your team is to identify which ones have provided good value as the market sold off everything. And so let's come back to that market for a second. When you're looking at the quality REIT side, what kind of things are you looking for in the future? I mean, what kind of returns are we sort of able to achieve? You feel confident about those returns, et cetera?
Well, firstly, we say in terms of the outlook, we say that our blood is supply and demand. Some of the cliches you hear in real estate, location, 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 we say is nonsense. I mean, you can have the best located office building, as you touched on, in downtown Calgary. How's that been going for you? Not so good. So it's always supply and demand. Interest rates are a bit of a misnomer. Sure, they're important to real estate, but supply and demand can trump interest rates, as we saw, in some of the takeovers where government of Singapore showed up in Canada.
Yes.
November, in the worst credit environment since 2008, in bid and bought one of our core holdings called Summit Industrial REIT, a $6 billion enterprise REIT, at a 33% premium to where it was trading at in the stock market. And by the way, a 20% premium to their own IFRS value, and probably within 3% of what I highlighted on your show. And when we highlighted this as single best M&A candidate. So
yeah, allow me to just interrupt you at that point, Jeff, because you did it more than one time. You said you've talked about Summit REIT several times on Money Talks, which we appreciate, but you talked to it about your also a candidate being taken over. So I want to just look at that. God, I mean, a terrible investment environment. The market had just topped out and had a tremendous decline coming in through November. It started, bottoming out at that point, and it was a 33% plus premium. I just want to pat you on the back for that. Those are the kinds of things I like as an investor. Just kidding. No, I mean, it went spectacularly well. But that was your top recommendation on Money Talks.
Yeah, I mean, it was something we were very active on. We toured every property. They were in Toronto and Montreal, probably the two best industrial markets on the planet. Vacancy rates were 1%, very high quality logistics space. And it was a sector where a cap rate, which is the unlevered return on real estate, which is a common moniker for real estate valuations, a cap rate was meaningless. Mm-hmm. When you had a 60% gap between the in-place rents and market rents, who cares about the 1 year unlevered return or a cap rate? You must use a discounted cash flow or an IRR calculation to ascertain that value, which is precisely, obviously, what the government of Singapore pension plan did. And if you read the circular, Blackstone came in, I think, number 2 in the bidding. And this is the kind of work that we do and they do to highlight why in that kind of environment it was compelling and why the stock market had this wrong.
But your point also about it's not so simplistic in these variety of types of real estate, beyond just residential or let's say single family homes, actually, where it's just, hey, the interest rates are X, this is going to happen. I mean, there's many more variables, at play there. And I want to come back to that differentiation. So give me an idea of what the top REITs you're looking at do.
So what we're looking at, we like, as I mentioned, single family rental homes in the Sun Belt. They're cheaper to rent per square foot than an apartment. You get a backyard, you get a driveway. It's typically families that choose to locate there based on a local school district. Big deal in the United States. Limited new supply. And now with, as I say, mortgage costs 7%, it's tough to buy a house. So that's a defensive place. We like manufactured housing communities, a very misunderstood sector. This sector's never had 12 months of declining net operating income, ever, including the Great Recession. It typically trades as a result of superior fundamentals, limited new supply, at a big premium to net asset value. We've loved the fundamentals, but that's not what we do at Vision. We don't want to buy at a premium. We want to buy at a discount. Well, in June 2022, in November 2022, in September 2023, you can buy into that sector at a discount to net asset value. Superior fundamentals at a discount. That's what we like. We continue to like industrial for those secular themes I touched on. We like necessity-based grocery store anchored retail, not malls, but necessity-based retail is a sector we like. And we're shying away. Our biggest short position today is U.S. healthcare. And particularly nursing homes. One of the differences in Canada and the United States, Canada, you see owner operators. The United States, you see folks that own the real estate. The REITs own the real estate and they lease the properties to operators. Well, those operators are having a hard time generating enough cash flow to pay their rent.
Wow.
The stocks are underwriting as if occupancy was back to 2019. The stocks are underwriting margins. Well, it's tough to get labor to come back. It's expensive to get it back when it does. And because of the shortage, they're using agency labor, which will cost 4 times as much. So we think this sector, in terms of valuation, has really got ahead of itself.
Yeah, the fascinating, as I say, when the market doesn't match, and of course that's how you've made a living, identifying these situations, but it is fascinating to see the market and the asset value reflected in stock prices just don't match the reality of the world. Like if you broke that company up and sold all of its real estate, it would be worth significantly more than the stock is allowing for. And it could be, it's rare that it's actually the other way around, but significantly more. And that's why I'm so interested in this particular environment, where, as I say, we get deceived because, the stock market rise has been dominated by, several in the tech, whatever, the magnificent 7 in the tech sector, whatever cliche I've got. But, that's why I was interested in getting a chance to talk with you to see, in fact, I personally prefer to buy when the crowd isn't outside the door, and I want it. And you look historically, that is just so consistent, for values.
We've had 20 takeovers in our holdings in 15 years. And you look today, the latest statistic from Preqin is there's $344 billion of dry powder sitting with pension funds and endowment funds that have a tough time, even with higher interest rates, getting a inflation adjusted real return on bonds. And they're increasing their weights from real estate from 5 to 10% to 15 to 20%. Private equity funds, fully funded in cash. The Blackstones, the Brookfields, $344 billion looking to buy properties. That's a great backdrop for REITs. We'd rather not compete with Blackstone, thank you very much. We'd rather sell to Blackstone, which we participated in 3 times in the past 5 years. In fact, Blackstone figured it out. They've bought 50 REITs since they launched the real estate group. Between December 2021 and June 2022, they bought 5 REITs. And so, one of our advisors at leading U.S. firm J.P. Morgan called us up in last quarter and said, "You guys are kind of like the farm team for Blackstone." I think it's a compliment.
I think it is too. But again, it's a case of, the other thing, we get a little hung up on the short-term headlines. That's maybe by nature. We do it in all sorts of markets and in other areas. But again, what time horizon do you use when you look at a property, you see it's undervalued, you go into the market, you take advantage of it? What's your time frame?
We're longer term investors. I mean, we might have liquidity in a day, but the themes we focus on are driven by supply and demand fundamentals that take time to work out.
Yeah.
So, and you mentioned our short in office. This was driven exactly by supply and demand. Too many new buildings being built at the same time demand was diminishing. And so we use supply and demand to establish a forward-looking models of net asset value. What is the real estate worth underlying publicly traded entities? And our themes, typically our core holdings will have, you've seen it, Summit REIT. How many times did I mention it before it was bought by government Singapore? They take time to work out. Our core holdings, 18 to 24 months or longer.
I don't want to finish without getting you to give me an example of what's interesting you now. I always put you on the spot that way, but I appreciate you sharing. And as you said, Summit REIT was one of those. Dream REIT was another one of those. So tell me just what's grabbed your attention right now.
I mean, we love something called First Capital REIT. It's a $3 billion market cap REIT. It's in the grocery necessity-based area. We've said publicly we think this is the best grocery-anchored portfolio, necessity-based retail portfolio in the world. That's a big statement.
Yes.
Why such a bold statement? One is in Canada, not in the United States. We have less square feet per capita. It's in 6 major urban centers only: Toronto, Montreal, Vancouver, Calgary, Edmonton. The stock's trading at a 40% discount to net asset value based on their IFRS valuation, which we agree with. And you get a 6% dividend while you wait for the best portfolio in the planet. So that's a name we like a lot. There's been activism in the name last year. We were quietly behind the scenes trying to be constructive in that regard. There's been some board refreshment there. And we're hopeful that's the beginning of the story and some of this value is going to be recovered. So that's a great name for your audience. I mentioned manufactured housing communities. We like Sun Communities, which is in that space. Again, 20% discount to NAV. You're talking about a $15 billion US market cap stock. We like Boardwalk REIT in Canada. We're shying away from apartments, but not Boardwalk REIT because it's in Alberta. There's no rent controls and huge population migration to Alberta. $3.5 billion market cap. It's cheap. It's had a great run. We've talked about it in the past on your show. We still see about an $80 net asset value. The stock's below 70. Industrial, we like 2 names: Dream Industrial REIT in Canada, 24% discount to net asset value. DIR is its symbol, 5.1% yield, $4 billion market cap. And in the US, we like First Industrial REIT, which is a $7 billion market cap. We think 21% discount on the New York Stock Exchange for First Industrial REIT. Control is in the market of that. Great management, great development pipeline, 50% gap between the in-place rents and market rents. They got 3 to 5 year visibility on how they're going to generate cash flow growth there. So those are some good names for your audience.
I'll add one more. Of course, all of that incorporated in the Vision Alternative Income Fund, which you can go to visioncap.ca to get more details on. But that's where people are putting, some of these suggestions into their RRSP. I mean, they take it in the Vision Alternative Income Fund in the RRSP. As usual, Jeff, a fabulous job. I could listen all day. Great stuff. So knowledgeable. But thank you for sharing. And again, the Vision Alternative Income Fund is what I'm talking about. And you can just go to vision.ca. Great stuff, Jeff.
Nice to see you. Thanks very much.